So it's been the talk of the morning. Dallas Fed President Lori Logan this morning suggesting there's no need to end rate hikes, and our next guest agrees, noting that last week's month-over-month CPI increase does not support a pause in June. Joining us now here at Post 9 is Deutsche Bank CIO of Wealth Management in the Americas, Deepak Puri. So the data doesn't necessarily support a pause, do you think?
Well, you could argue either way, Sarah. I think what Fed Governor Logan is saying, that there's still enough, you're way off the comfort zone of the Fed. 2% inflation is something that we can aspire to this year or next. And the labor market's being so tight, so why give the markets this, pause signal? Why not stay a little bit on the hawkish side and then see how the markets react? On the other end, you have Governor Jefferson, who's saying that the monetary policy should be forward-looking. It needs to take into account what's already baked in. And you look at the regional banking crisis, the sort of credit tightening you're already seeing, a good argument could be made that it's time for a pause. So I think right now it's a difficult balancing act for the Fed to go through whether do they go, and hike, because that's what just one inflation data is warranting. But on the other hand, when you look at the overall broader picture, it could be easily said that it's time for a pause.
I totally agree. We argue both sides of it every morning. For the equity market, though, isn't the bottom line that nobody's talking about cuts? In fact, we're still talking about whether they should keep hiking. So is that a big risk for stocks?
It is to an extent, but I think almost all of us have completely underestimated the wealth effect, the income effect that the pandemic era created. I mean, you're looking at a demand number that is still pretty strong. I mean, who would have thought that even after 5% of rate tightening, we are going to be looking at 3.4% unemployment rate and a retail number the way it is, and a whole host of other data points that still suggest there's pent-up demand, there's still decent reason. And on the equity side, Sarah, the one thing I'll say is that I think there's also been a reality check on the corporate America side, in a way that companies have also figured out that the rate regime is going to be very different for the next few years than it has been over the past decade and a half. So they need to clean up their act or get cleaned out in a way. So they are much more efficient, using better technology, supply chains are getting simpler, business models are getting simpler, and I think that's also helping the cause for equities.
I wonder, sometimes we talk about Australia's central bank,
Sure.
where they signaled a pause, came back for a little bit more. Is that seen as a mistake, or is that something that the Fed could try to replicate in their framework?
Well, they could try, but I think Australians' economy is a little bit different, and they were the first one to embark on YCC, yield curve control, along with Japan. So a bit different dynamics. But on the other hand, I think the Fed, as Jay Powell has said, it needs to be meeting by meeting, stay course corrected. My concern is if it's truly data dependent and the data comes really strong, would the Fed then increase rates? To our initial point, would the Fed have the ability to bypass what the rates market is suggesting, which is rate cuts by the end of this year?